Welcome to Markets Now. I'm Michelle Rourke with Kent Beadle of Paradigm Futures. We had kind of a mixed trade in both grain and livestock futures today. And let's talk first of all about the most volatile market, Kent, which was the cattle market. We had a gap higher opening this morning, and some of it was news headlines on screwworm, and that was counterbalanced by the cattle on feed, right?
Yeah, we've heard that the Mexican border is now closed to incoming cattle. We don't know exactly how long that situation is going to last. It is going to impact the number of feeders that can move north from Mexico and could start to significantly hamper supplies. We rely on Mexico for probably somewhere in the neighborhood of 100,000 head of feeder cattle a month. So it's not an insignificant situation. We gapped higher on the open with that news, but without any corresponding, clarification as just to what might happen or for how long. We went back and started to trade the cattle on feed report. And of course, the cattle on feed report showed 104% of placements. That was a number that was bigger than anticipated. So at least as of the moment, we probably have a few more cattle in feedlots and a little bit more supply coming at us. And some of the traders use that gap higher open to sell cattle based on the numbers of cattle that we have in feedlots right now.
Yeah, no doubt. And we ended with live cattle lower, feeders well off of their highs. But man, feeders have had such a big run anyways. You would have thought we were kind of due maybe for a little correction here pretty soon, aren't we?
Yeah. They were very overbought. Despite the higher cattle trade last week and the higher cash cattle trade that we also had, your cattle crush margins, which take into consideration feeder cattle and corn, were actually solidly lower last week because of the expensive feeder cattle. So these high price feeder cattle are making it a little bit tougher on the break evens for the cattlemen right now.
So cash trade, as we mentioned, was steady to actually higher in the South. And I think the strength was a bit of a surprise. Do you anticipate we're going to see continued strength this week or not?
Well, when you have a surprise like that, typically you end up seeing some follow through. If I was to put a call out today, it would be steady to $1 higher for this week's cash. Of course, last week we ended up primarily $2 higher amidst a lot of steady calls earlier in the week. So, it does feel to me like these underlying firm fundamentals are going to result in some higher trade here again this week.
No doubt. So the hog market, we did end higher there. We're back close to retesting the highs here, even though funds have gotten rid of some of their big long record short position. So do you think we retest those highs?
What the marketplace is concerned about is a disease showing up in some parts of the U.S. We're hearing a lot of PRRS that is potentially going to be a problem, contracting supply a little bit. To me, it's fairly clear that we've had some really, really solid demand, and I'm not sure that we have necessarily seen all of it in the weekly export sales reports, but this has been a market that's been surprising to, really everyone in the industry, and it's caught a lot of people, a lot of hedgers flat-footed here. There's been a lot of hogs that have been sold cheaper than here, and the market just wants to keep on trucking, and right now the momentum is in its favor.
Kent, soybeans managed to enter the plus side on Monday after a nice reversal on Friday. Is that just because we keep hearing these rumors of China export business that they're going to buy some more U.S. beans?
Well, they have been buying U.S. beans, and they have bought additional beans, more than likely 10 to 12 cargoes again last week at least. And we think that they're probably in here again today. This isn't unusual, but we have very likely hit our peak sales period. We're going to start to see export sales start to move lower, but we're very much on pace to what we would expect to be. We have sold and shipped 65% of our of the current export sales estimate from the USDA. That is right in line with the 15-year average. The window of sales into China, stay open through December and probably through January. We've heard rumors of a cargo or two maybe getting booked for February as well. But once you get into February, we're going to be more expensive than the Brazilian stem. And, we anticipate that beyond the end of January, we're only going to get the occasional spot cargo when logistically Brazil can't necessarily execute.
Yeah, I've heard that as well. Soybeans obviously have been under pressure. We're just off of contract lows. It's been concerns about the big South American crop, concerns about tariffs. But are we at prices low enough that we need to be worried about that U.S. farmers are underwater here, that we're not going to be profitable on soybeans? Or are we at levels that maybe would discourage some soybean plantings from South America at some point?
Yeah, so about a week and a half ago, the USDA issued their revised cost of production estimates for this past crop, for the 2024 crop, and put out the initial cost of production estimates for 2025. And those cost of production estimates in both cases are around $625 an acre, plus or minus. Based on last year's yield, we calculate out a break-even cost for the American farmer at an average of $12.09. You've got a futures board here right now that's at $9.85, and of course, basis levels are less than zero. Relative to just the futures board, relative to cost of production, we are $2.25 underneath those costs, and those are equivalent to the very worst levels that we saw in 2018, or the 2018-19 marketing year, and then again the 2019-2020 marketing year. So, in our view, the market has, done a pretty good job in trying to price in not just the supply side and the carry out, but is also trying to price in a trade war that really hasn't even quite begun yet, as the Chinese are still actively buying U.S. beans this year. The market certainly is concerned about what might happen next year, but a lot of the worst case seems to be priced in if you want to look at things historically relative to what happened in 2018 and 2019.
Good point. So the corn market tried to follow soybeans, and we had reasons for corn to be higher today. Strong cash basis levels. You had some Mexican export business. Did that market just get dragged down by wheat?
Yeah, that's what we're really looking at here. Over the last number of weeks, as wheat prices have continued to fall, and as corn prices have rallied. Keep in mind, corn is 40 cents off the contract low. That spread between wheat and corn has tightened up some more. And while we don't still see wheat being particularly economical as a feed, it's getting closer. And when wheat has real tough days like the one it had again today, it just does seem to have some pull lower on the corn market. I think we saw that over the course of the session today.
Yeah. And the wheat market, obviously, we had a higher weekly close last week. So was some of this just profit taking, or is this anticipation of better ratings again on winter wheat?
Well, let's start with the reason for last week's rally was the escalation of the military situation in Ukraine and Russia. And as the week progressed, though that escalation seemed to calm down. So Thursday and Friday's trade in the wheat was still lower, and we didn't have any escalation over the weekend. So it certainly appeared as if the overnight trade in wheat was, number one, a function of no resumption of major hostilities. And then the second reason, of course, is we have had rain in the southern plains and we've had improvement conditions. We're going to get the last condition rating from the USDA today, and a number of traders anticipate that we might see another uptick in condition ratings. So I think traders were trying to sell the market ahead of that report.
Yeah. So with wheat being down, taking out a little war premium, do you see that market continuing to slide here now?
I actually think it's going to be supported at recent lows. Um, you know, I'm still of the opinion that we've tightened the world wheat balance sheets a little bit with lower production in Russia, lower production in Europe, lower production in Australia, although maybe not as bad ultimately as what people had thought a couple of months ago. And our U.S. crop, at somewhere around 50% good to excellent, is actually in similar condition to where it was at this time last year. And, it could end up being a good crop, but it just as easily could end up being not so good. And I think we need to maintain some weather premium ahead of this upcoming spring.
All right. Thanks for joining us. Kent Beadle with Paradigm Futures. That is Markets Now.